Becky is saying, my husband and I have $50,000 we're looking at putting in a money market account that earns about 3%, or paying down a home equity line where we purchased an investment property back in June of this year. We owe $150,000, but interest rates have risen to over 7%. At the time she wrote this, they may be down to under 7% right now, because this was from a couple weeks ago. Which would be the better option? We're leaning toward paying down the home equity line. We both still work and have a 401k. I regularly put money in. We have $25,000 in emergency funds, and I'm 61 years old. What do you think, Shanna?
Well, you want to first make sure that you have enough money to carry that property. If something happens, if you lose a renter, that you're able to pay the note. You want to make sure that you have kind of the cushion for that particular property. If a renter damages your property, do you have the money to be able to fix it? So on and so forth. So if you've got that covered, and you have a variable rate, which is what it sounds like, on your home equity line of credit, and it's bumped up, it's going to follow rates up and down. So you may want to put some money to it, as long as you have enough money that stay in liquid that you can use to maintain and keep up with your rental property. But you just have to keep in mind that any money that you put back into it, you're going to have to get back out of it if you don't have those safety nets there. So paying down a 7% rate is good. The other thing that you have to be really aware of is that you have basically put your home that you probably live in as collateral for this rental property. So you never want to be in a position that you could lose your home because of what happens with the rental property. So a pretty good idea to put at least some of that money to paying down that line of credit.